Okay, we have an awesome show for you today. I have the Acquired Boys joining me again. Ben and David are with us. We're going to talk about Roelof taking the reins at Sequoia from Doug Leone. And we'll talk about the Fast.co implosion. Who's responsible? Who's most responsible for that train wreck? And my pal Lon Harris is with me again this week. No solo dolo today. I brought in reinforcements since Molly's still on vacation. She'll be back on Monday. Brought in Lon Harris to do the final episode, episode 8 of The Dropout, and what this means. Will there be a second season? And who deserves more jail time, Balwani or Elizabeth Holmes? We're going to answer all those today on This Week in Startups. Stick with us. It's going to be a great show.
This Week in Startups is brought to you by Fiverr. Get access to millions of freelancers around the globe to help turn nothing into something today. Go to Fiverr.com and use code JASON for 10% off. That's Fiverr.com and use code JASON. Ourcrowd. Ourcrowd helps you invest early in pre-IPO companies alongside professional VCs. If you're interested in investing, you can join Ourcrowd for free at ourcrowd.com/twist. And Notion. Notion is one place for notes, docs, projects, and everyday work that goes way beyond a wiki. Go to notion.so and use promo code TWIST to get $250 off an annual team plan.
For those of you who don't know, Ben Gilbert is Gilbert on the Twitter. Yes, he's been around for a while. He got a solo name there, and he is the managing director at PSL, Pioneer Square Labs. Now, there's another Pioneer Labs that popped up subsequent to yours, right?
Yes.
Daniel Gross's. Is it Daniel Gross is his name?
Yep.
Yeah. Now, wait. How many years after you did Pioneer Square Labs did he do Pioneer Labs?
I don't actually know.
I think Pioneer app.
Pioneer. I think his might just be Pioneer. I actually don't know a ton about it. We started
it's just Pioneer, and the website is pioneer.app.
Got it.
Yeah. We started September 2015 So he may have even been around then too.
Interesting. You know, I have this problem with launch. Everybody's like, "Oh, launch fund," and I'm like, "No, that's me." They're like, "Launch festival, launch conference." I'm like, "Also me." Like, got those trademarked. Could you pick something, just a little Launchpad conference? I'm like, too close.
And wasn't there like a launch? There was something. Oh no,
there was launch.com, which my friend Dave Goldberg, rest in peace, did, which was a music. It was the original, like Spotify, and that is now owned by Yahoo. But Yahoo had bought it, so they actually own the domain name launch.com. And so I've been talking to them about the domain name for the better part of 10 years. For no other reason than it's kind of like a Moby Dick kind of situation for me. Like, you know, like inside.com was a Moby Dick for me. I was like, I really want that domain name in the 90s. I was like, I got a really good idea. It could be like about.com, but you would go inside. So it's like deeper. And
there's something in your soul that feels good when you get the short domain. It may not be like our friends at Tiny just got tiny.com, and that has to feel real good.
Absolutely. When you have a dictionary name or an @ handle like Jason, you have this wonderful moment in time where everybody covets your home. It's like having the best home in the neighborhood. And everybody's like, if you ever sell it, you're like, never selling it. They're like, but if you do sell it, you're like, never selling it. My daughters are, my grandkids are going to live in it. They're like, but if you did, I'm like, never selling it. So literally, like, very famous Jasons have come to me. Hey, big fan. I'm like, not selling the name. It's like, well, you know, you ever want to be in an action film? I'm like,
oh, wow. The stakes are getting high here.
I will give you the name if I can defeat you as the supervillain in the film, where like literally I beat the out of you and you basically bend the knee and say, you know, I give up. You were the new action hero. So,
not to play David Sachs here, but like there would be a lot of computer generated, like a lot of, you know, if you were going to be the big muscular. Yeah. Getting there. All right. And David Rosenthal is here with us as well. He's wait, are you DJ Rosenthal?
DJ Rosen. This was my college email address.
Were you literally a DJ in college? Or did you just use
like the randomly assigned, like, you know, string of 8 characters that Princeton gave me?
Is your middle name with a J?
James. Yeah.
So you literally are
both
DJ.
Both of our middle name is James.
Yes.
Is it really?
Yeah.
Look at you guys. So you are
so cute.
DJ. You're literally a DJ, Rosen.
I am a
co-founder of Kindergarten Ventures, which I am proud to say. I got my beak wet. I put a little. I think we can say that I'm a minor little LP.
I'm very, very happy for you to say. I'm thrilled.
Oh yeah, I just Thank you. I like David. I decided like I'm saying no to every venture firm. But then like friends of the show, or maybe like somebody I've known for over a decade, like maybe put a little taste in. I mean, listen, I got the cheddar laying around. But now I'm in like 22
our
funds.
profile just went like, 100x.
Listen, I get invited to almost, I wouldn't say all funds, but I get invited to a lot of funds because people want to build that fabric or whatever. And it's just too many. I mean, I'm so over-indexed in venture. I mean, you guys have probably experienced this, and I'll let you sort of chime in on that. But you need to have a strategy when you're a venture capitalist where you're 80, 90% venture, 10, 20% other, as opposed to like, if you were a perfect portfolio manager, you would say 10% venture if you're aggressive.
Meanwhile, for you and us, and not only is it our investments, our portfolio is all in venture, but like our operating business is highly indexed to startups and venture capital as well. And with Twist
in terms of the pods. Yeah,
the pods.
Well, there is something about being all in. So how do you both think about as you throw off capital and you're over-indexed in venture? Are you comfortable being over-indexed in venture? Because let's face it, it's like, it's the area of your excellence. It's the most domain expertise you have. So you can be more comfortable operating
and where else would you want to be, right?
Well, that is the question. Do you ever get nervous you're over-indexed, especially in a time like we've seen from Q4 into Q1, and now going into the next year when everybody's predicting a recession? This maybe isn't the best place to have been, but it could be the best place to start. So let's just start. Maybe Ben, give me your thoughts on your personal psychology right now, because managing personal psychology in a downturn with a predicted recession is important.
Yeah. Well, so you're asking if I'm okay being in just very boring, regular venture, really heavy, and not just everything in crypto. That's the question.
Are you thinking about going even more? I'm going to take this Tesla jacket off because I'm so hot. But for people watching the stream,
it's a good looking jacket.
This is one of the original 100 Roadster owners. I'm going to go to Austin right after this for the Tesla rodeo. So I'll see everybody there tonight. But this is the original Tesla logo. For people who don't know, that's what the key of the Roadster looks like. It's that little, I don't know what that is, like a triangle. With
they dropped the shield, right? So now it's just the
it's just the T. It's not the shield,
cool.
But it was like
you
a shield.
You still have it, right?
I have it right here. Yeah, it's actually somebody the Rally Road team wanted me to put it on. I don't know if you know Rally Road, which is just fractional ownership of assets. Sorry about the noise. You're going to hear my jacket coming off. I think we were talking about putting it on for $250K. It turns out those Roadsters were worth 10 years ago. People were selling them just to get them out of their garages, the original Roadsters, which they were going for maybe 40, 50 grand. They originally cost 150. They had dropped down to 40, 50.
What an investment.
Now, 10 years later, they hit classic. They're starting to get towards classic car style, age. And obviously Tesla's doing well. And there's a small number of them on the road. And when they get in accidents, they get totaled because they're tiny little cars. So there's a guy who buys all the used ones. If a car gets totaled, he buys them for 30, 40K now. You could buy a pristine one with under 50,000 miles for 30, 40K 10 years ago, or so, because everybody, when the Model S came out, now it's 250. And then maybe for one that has some uniqueness to it, like the first 100, it could be a little bit more. So, and then I have Model S number one, which I think is worth $1 million maybe. So those two cars kind of, but anyway, Ben, let's talk about, so those are my non-tech assets, I guess, that are,
One more real quick little sidebar. I finally got a Model 3. It is unbelievable.
Model 3 is the greatest car ever made. I think the Model Y is even better, but the Model 3 innards are now, I think, matching the Model Ys. But what is your favorite part about the car, may I ask?
Ooh, my favorite part about the car, I was not into driving before I still wouldn't consider myself like I care about performance or anything, but just like, it's just the windshield and you are so there. Like the screen is kind of out of your field of vision. So it's just, I thought I would miss the instrument cluster. I never want an instrument cluster again. Like you just see out and it's amazing. And it's so responsive. It's instantaneous. It's like I'm like my body is like going down the road. It's amazing.
It is.
David says he doesn't care about performance, but we drove from San Francisco a few weeks ago down to Sand Hill Road. And of course he's on the entrance ramps and he's like, you want to see what this thing can do?
I had a friend who liked to this a friend of who's not me. He would double the speed when he get off turns. Then he would go like 2.5, the exit ramp, 3 the exit ramp. It's like, dude, it's a 50 mile per hour exit ramp. You're taking it at 45. The tires are starting to grip and squeal in your whatever car you're driving. I don't know, let's hypothetically say a Corvette or something. But it is a pretty amazing car. But you drove like a Honda. You're like a Honda Accord kind of guy, I take it.
I had a Acura station wagon. Still have. It's
okay.
great.
Yeah,
Throw a bunch of
totally,
stuff in it.
totally on brand. Like a totally pragmatic. This is a good car to have for 10 years. Ben, you're a BMW guy, obviously.
I'm a 2008 Porsche. Honda CR-V guy.
Oh, that's a little bit of a sporty car, the CR-V, right?
Maybe
It's
now.
the
It's
SUV.
Oh,
not from 08.
Oh, the CR-V is the SUV. I'm thinking of the other one. There's another one with a 3-letter name.
There's an HRV that's a tiny version. There's a Toyota
oh, you know what I'm thinking of?
CRX, which is a weird.
No, I'm thinking of.
Yes,
there is the Nissan
That's
GT.
the dream car.
Oh, look at that! Whoa, yeah. Oh, you are a huge nerd.
Bought it fully depreciated. Like this is like fully optimized.
You know what? I thought you said Nissan, and I was just thinking you had a Nissan GTR, which they nicknamed Godzilla. So this is what all the Fast and Furious kids drive. Like when you see people doing donuts in those showcases in San Francisco, whatever they call them, where they go on the street and then make donuts and everybody goes around them and cheers, and then somebody gets hit by the car and everybody cheers more. Those, what do they call those? There's like a name for them here in California.
Rallies?
Showcase, rally, show something. Anyway, they do these things, incredibly dangerous. And then the cops come and they're just like, yeah, whatever. And it turns out they steal the cars or they steal the tires off of your car, put them on their car, melt the tires, then swap the tires back. Dude,
did you know that Jensen Huang, the incredible NVIDIA CEO, one of the greatest of all time, he's got is it Koenigsberg, I think, that crazy supercar thing, but he used to have like literally a Fast and the Furious Toyota Supra and used to like race that thing and almost died. Crazy.
Sam Altman's into racing cars. There's a bunch of people in the tech scene who are into like racing cars. I'm into living a long, productive life. DHH likes it. I'm into like surviving for a long time and enjoying the last 20, 30 years of my life. We all know how hard it is to build something out of nothing. That's what the startup game is all about, and it's easy to quit. According to a study conducted by Fiverr, 25% of people surveyed revealed they had a business idea in the past 18 months, but almost 60% of them never pursued it. And the majority said it was due to a lack of resources. So here is how Fiverr can help you. Fiverr's talent marketplace has millions of freelancers across the globe, and they're accessible in just a few clicks. They have experts in design, data, marketing, website building, music, video animation, and so much more. Just search for the service you need and set a timeline and price. Then Fiverr will provide a list of freelancers who meet your criteria. You can browse their portfolio, read the reviews, and you know exactly what you're paying for before you pay. We love Fiverr. We've used it for many research projects, design projects. They do a great job. They can get somebody up and running almost immediately. So here's your call to action. Every successful something was once nothing. So head to Fiverr.com and turn nothing into something today. You're going to receive 10% off your first order by using my code, Jason. What a great code. At Fiverr.com. That's Fiverr.com. And use the code Jason, 2 R's in Fiverr. Ben, in all honestness, let's talk about portfolio construction here as capital allocators. Obviously, the joke is, go deeper into crypto. We can dunk on that in a minute. But how do you think about it? Are you just comfortable? I'm assuming you're well over 50% of your net worth is tied to tech.
Yes. I've thought a lot about this, as you can imagine. And personally, I kind of look at it like I'm extremely comfortable with that. And not just tech, mostly early stage tech, given the fact that I'm 32. Like I hope to spend money later. I don't really have a lot of need to spend money right now. And so I'm comfortable with a large percentage of it being super high risk. The other thing about being in venture is it's not like being a startup founder. You are reasonably diversified. Like there's almost zero chance you're going to have a 20x fund if your fund is large enough. But like you should feel pretty good about generating a return and hopefully generating a 3, 4, 5x return from your fund. So I've sort of looked at it like I am way over indexed, compared to what any financial advisor would tell you in what they used to call alternative assets or early stage tech venture. But I don't know.
It's interesting. Right?
That's where my passion is. That's where my unique advantage is. That's the stuff I understand. I feel
it's like if you were a great poker player, you would not be playing gin or rummy or backgammon. You would play more poker. So I think that's a really great insight. David, what's your take on this? Or you had a question for Ben, maybe?
Well, I got a question for both of you, but more you, Jason. Like, okay, so I've been working in venture for one way or another for 12, 13 years now. I don't know that I've ever seen an individual fund lose money. I think it's very hard for a venture fund, even the worst venture funds, to be negative in the long run. Have you? I mean, I'm sure it exists, but like, what's your experience?
I think you don't hear about it, and I think those funds go away. So if you, let's say you put up bad numbers, 2 funds, and I think you could probably get away with it for 2 funds, and if you really sucked, then maybe you don't get the third because you're racing the second, in the J curve of the first. So
yes. All of that, and like, I don't mean bad.
Also, by the way,
relative performance.
You said you've been doing it for 10 years too. We've all been doing it since for just over 10 years, right?
Yeah, I think I'm probably.
But I just mean
7, 8.
Like truly bad funds, bad firms relative to everybody else. David, they almost never are below 1x.
We all started in 2009, 2010 after the great. We've literally done a bull run for 13 years. So it's kind of like it was high tide for us. It was a massive dumping snowstorm. We all look like, we're great skiers, great surfers, but now that there's no snow.
Funds, and Madrona is a great firm. So like they're in a great league, but I joined their fund, started in 1999. That 1999 fund went deep in the J curve and pulled out and ended up being close to a 3x fund. Yeah.
How close did they come to hitting the ground or the water?
Oh, well, shoot. I mean, I don't mean this to be a knock on them at all. Like they're great in that they survived. Like, but it was, I think, 99 to 2005 until they raised the next fund. 6 years with
basically like your plane is like one engine and you're flying like 2,000 feet above the Pacific Ocean and you're like somewhere between like Hawaii and Australia.
Yep.
And you're just like, this thing's going down any minute, but we got a little fuel. We got one engine. We're at 5,000 feet. We can see the water. Let's see if we make it to New Zealand. Maybe we find it to Fiji. Maybe there's some, Polynesian island we can land this thing on.
Sequoia is the same story from the .com fund, right? Like, what was Doug saying that they did during
they burned cigarettes in their arms before they lose money in it.
Yeah,
and they cigarettes in our arms before we lose money. I love that.
They foregoed their management fees during the 99-2000 fund also, right? To try and make sure that they were returning capital.
I think it's going to get very real for people. I think we're going to see a lot of VCs quit in the next 2 or 3 years. I think what's going to happen is when people have to go to 3 or 4 board meetings and watch layoffs and watch valuations become so crushed and depressed that they look at their portfolio and go, you know what, this thing's not going to recover. What you'll see is like if there was a 5-person team, you might see 2 people go, you know what, I'm just going to join this company or I'm going to retire. I think you're going to see that like changing of the guard if we do have a crisis. And I don't think that's guaranteed, but certainly something's going on. None of us are macro here, I don't think, but let's pretend we are.
But the good news is, like, if you look at America's track record over the last 250 years, you don't need to be a macro expert as long as you have a long investment period. Like,
such a good insight.
Like, none of us need to. I kind of look at it. I think I've sold maybe like if I look at my stock portfolio right now, I just don't turn it over. I just have my like 20 to 30 companies I really like. I keep adding to those positions. I've sold like 1 to 2% of the value ever, and I kind of look at it like I'm not trading, I'm investing. And so we probably will have some rough years somewhere in the next 5. I don't know what 1 or 2 or 5, but I don't know.
But if you own Amazon or if you owned Airbnb, I don't know what names are in. If you own Disney, the idea that Disney, Airbnb, Google are not going to be relevant in 2030 or 2040 is kind of farcical. Like they would really have to destroy Google or Disney if you deliberately tried to do everything wrong. Like literally said, I'm going to make the worst decisions I can make every day when I come into work. I don't think you could stop those juggernauts. Like you're not allowed to turn it off, But you get
from
to
what
make
I can tell,
terrible
no
decisions.
one's done anything new at Google in like 20 years anyway. So they just have the most successful high margin business of all time, and then
literally they built a
effectively
diamond
monopoly,
print.
and they all go
This
home.
is a Warren Buffett quote. I forget how he phrases it. My more crude phrasing is that you want to look for businesses that literally like everybody could go home and a monkey could run them.
Yeah, basically it's anti-fragile businesses. They do arguably better in chaos. And Google certainly is that. Like if whatever happens in the world, you shake the globe, the snow globe, there's no world in which people are not searching for information and clicking on ads that match the search term. Like they just built the perfect engine.
Here's a bear case for Google, because I've been thinking a lot about this. Not investment advice, but I really like Google as the stock.
Oh,
and
Nick, super producer Nick just came through with the quote. It's so much better than mine. This is Warren. Invest in a business any fool can run, because someday a fool will.
Ooh.
Wow. That is a rare moment of perfect
shade from Warren.
Clarity from a capital allocator who has actually literally watched somebody take one of their great businesses and try to drive it into a wall. Like he's talking about a person there. I don't know which person, what they did to him. I don't
Solomon
know who
Brothers.
hurt him, but somebody hurt him, and that's the subtweet of the year, of the century. Who hurt you, Warren?
It's definitely Solomon Brothers.
Thank you for the
definitely
Nick,
John
great
Goodfriend
job on
and
the
Solomon
punch ups
Brothers.
today. Like I circle around the joke, and you could see me like forming the joke in my brain, and then Nick's like, boom, he just snipes it. Who hurt you, Warren? It's time for another Ourcrowd deal of the week. Right now, you can join Ourcrowd's investment in Ciabra. According to the deal memo, Ciabra's AI-powered SaaS platform analyzes billions of online conversations, and they do this to help companies gain authentic consumer insights while fighting disinformation in real time. Ciabra's customers are global media corporations, consumer brands, and high-level government agencies, according to their deal memo. You can invest in Ciabra at ourcrowd.com/twist today. All over the world, companies like Ciabra are innovating and driving returns for investors, and Ourcrowd analyzes many of these companies, and they select the ones with the greatest growth potential and bring them to you. They invest from personalized medicine to cybersecurity to open source intelligence, which, according to Ourcrowd, is a multi-billion-dollar market. Ourcrowd identifies innovators so you can invest when growth potential is the greatest, and that's early. So if you're an accredited investor, you can join Ourcrowd for free at ourcrowd.com/twist and review all the current deals. That's ourcrowd.com/twist to sign up for free. David, how are you thinking about your capital allocation in a crazy time? Or do you not even think about it and put your head down and work?
Generally, all of the above. Generally, my philosophy is much like Ben and I think yours. But I actually have made a change with all the recent stuff going on. Just on the margin optimization. I have moved as much of my tech exposure into my retirement accounts as possible, because I want to hold it forever and just like be as long term as possible.
So you're doing the Roth IRA thing. I have an old Roth, and then making contributions every year to new ones. So I've shifted. I've used the market downturn as an opportunity to tax loss harvest a little bit, shift stuff into the retirement accounts, and then in non-retirement stuff, I'm actually mostly Berkshire at this point. I view that as like I actually think Todd and Ted, the investment managers there, are fantastic investors. The Berkshire Apple investment is one of the greatest investments of all time, period, full stop. When did they make that? Explain that to the audience what they did. Because
between
he really only owns, he doesn't like tech stocks. He likes Snowflake
and 2019.
Apple.
Yeah. But it's not Warren or Charlie. It's Ted and Todd at this point who are doing this.
So wait, when did they do the investment? You said 2013?
I think they initially started the position around 2015 and have been adding to it.
Yeah. Anyway, I'm very happy to get broad market exposure through a great investor for them in my non-retirement accounts, still get some tech exposure. And then for my active investing, I try to do it mostly through retirement.
I've come to two things. One is keep investing early.
Yep.
Earlier in the life cycle, as early as possible. And then I'm trying to perfect the building of a position in the winners. Those are the two things I'm trying to do. So vis-a-vis the WhatsApp, backing up the truck position. I'm trying to do that, but earlier. So, you get somebody and take more risk in getting people into the accelerator, right? There's only really 4 accelerators that I think actually are worth going to. If you're a reasonably good new founder. I think we have one of them. We're on our 25th class, 7 each class. We've had, 5 or 6 companies become worth over $100 million and already, right? It's a nascent program. And then we have a unicorn now. Grin became a unicorn out of it. And we have 12% position in Grin. And so, that when I started under 1% positions in the Ubers and Thumbtacks and Robinhoods of the world with these 25, 50K checks, then 2% of Superhuman, 5% of Calm, 12% of Grin. You go along that sort of journey and all of a sudden, having a fraction, you could build a 9-figure position by owning under 1%. If you, if you split the arrow with an Uber investment, you can hit $100 million position if you have 5% of just a, $2 billion company like say Calm. And then, if you have 12%, you can hit a $100 million position with it being an $800-900 million company. So I think that's just the position I'm coming to. Now, David, you do small investments right now with Kindergarten, and you don't care about pro rata, or you do fight to get it. Which one?
Yeah. Oh, yeah. Everything I was talking about before, I should caveat, is just personal account, trading of not venture investing. The vast majority of my investing, and Ben's too, is venture investing.
But trading the personal account teaches you things. I didn't used to trade individual stocks, and in the last couple of years, I've been doing it a lot. And I think it's really valuable for early stage private tech investors to be forced to grapple with public market realities.
The Altos guys talk about this all the time. They made the Altos, I think they talked about this on our episode, the retirement plans for the firm there. They all actively manage. I'm sure if you wanted, you could do an index fund or whatever, but they decided this is going to be part of our culture. We're going to learn by doing that and then apply that to, and it's
because that's what the LPs
dividends
in their funds might be. The high net worth individuals in their funds are probably doing it for some part of a retirement play or for their kids. And, that's actually a very clever way to stay in the game. But tell me how you are thinking about, now that I'm an LP and I'm now on the LPAC.
You and I both.
We're the LPAC.
Here we go.
I didn't see that in the side letter.
David, I'm looking at this investment in a CPG company. You invested in a sports drink. When you pitched us, you said you were going after SaaS and marketplace. How did this investment happen? Take us through how you sourced.
When he pitched you, he didn't say he was going after.
Oh, they were a college roommate. Oh, how interesting. You had the inside line on a sports beverage with your college
no conflict,
roommate.
No interest.
Okay, well played.
I'm still figuring out. We're still figuring out pro rata. It's such a different world now with AngelList, right? My current operating assumption is we will not be doing follow-on and pro rata in investments that we make in a given fund. Out of that same fund, we will probably do it in the next funds, do it kind of daisy chain.
Yeah, as long as you tell people that you're daisy chaining, it's totally fine.
Yeah. I think we're going to daisy chain rather than do a traditional venture style, which I did, forever of, raise a $250 million fund of which 100 is initial investments and 150 is reserved for pro rata. I just then you're trying to predict the future. And I think daisy
make sure you
chaining is better.
Fight for pro rata every deal. And say, I'm a value-added investor. I have a podcast. I can help in other ways. Please make an exception in the side letter. Please give me pro rata. I'm going to work for it. And it's going to be such a de minimis amount. It will really help me raise more funds and help more founders. That's the script. Clip it here and just keep saying it over and over again. Do not fight for that pro rata. You never know when you're going to hit something big and that pro rata could be worth something. You come to Uncle Jason and say, hey, you got those LPs sitting out there. Maybe we could do my pro rata and split the carry. And I'll be like, yum, yum, let's go. Let's go.
I knew there was a reason you invested.
Of course there is. And Ben's like, I'll do that too. Secure the bag. Startups need a central hub to store information and collaborate on work now more than ever. That's because we're all living in this crazy remote world. Everybody wants to put all the information in one place, and that one place is now Notion. Documents, projects, all that stuff, it kind of goes in the same place on what you could consider a wiki. When we went fully remote in March of 2020, Notion became our internal knowledge bank. We even use it for external purposes. You know, like when we did this series on This Week in Startups called the Startup Checklist. Well, we just put it at thisweekinstartups.com/checklist, and that is all hosted on Notion. On Notion, every team from engineering to sales can work together seamlessly, and they have 500 integrated apps, including things like Google and Slack. Collaborate in real time and tailor workflows to your needs. Hundreds of thousands of teams worldwide are already delighting their employees with Notion. Notion is now a worldwide community of millions, and they're creating templates and tutorials, so the product is continually improving. Just go to notion.so and use the promo code TWIST, and you will get $250 off their annual team plan. That could be a couple of months for free, so it's pretty great for a growing startup like yours. That's notion.so, and use that promo code TWIST during checkout for $250 off. All right, let's talk about Sequoia since I have you here. You guys did a great two-parter on Sequoia, and I just had Doug Leone on episode 1403, and I've been friends with Roelof, who's on the board of Inside.com, previously Mahalo, been a friend of mine for a long time, and he picked me to be the first scout for Sequoia, so thank you for getting my entire career in angel investing started in many ways.
Is Roelof still on the Inside board?
He is. Yeah. I mean, we do amazing quarterly board meetings. He shows up. He's been late once. Like literally something happened and he gave me $100 bill when he walked in 5 minutes late, and I framed it and I have it on my wall in my office. I had him autograph it and I put it on my wall in my office. And I'm going to start that at my firm. Late for a meeting, $100 bill. So what does this mean, I think, in the industry to see this changing of the guard and Roelof taking the baton from Doug, who basically worked with Michael Moritz. I think they had the baton together, who took it from, I guess, Valentine. So here we go. The third generation, basically. What does it mean to you, David?
Well, first off, I have to say your interview with Doug. I mean, any interview with Doug is great. You're starting, on third base, but like you did, that was so good. It was like just
it's a top I could 5 tell episode. I think. Yeah.
When I could see it when I was watching that interview. Like I was like, oh, Doug's gonna retire. Like,
David texted me. He's like, this is the farewell tour. You got to listen to Jason's episode. This is the farewell.
Yep.
Yeah, and, I got that sense of history when I was talking to him. And I also got the sense, like since we've known each other and he's mentored me to a certain extent, which people don't know about. And I try not to talk about personal relationships all that much because I feel like it's, up to the other person, maybe if they want to talk about it. But he mentored me a lot in venture when I was raising my funds, as did Roelof. But Doug took a particular interest. And I think there was a level of trust in like the interview, which when you're lucky enough to have a personal relationship with somebody like I had with TK when he did that seminal two-parter, or Saka, or Tremouth in some early interviews, like, yeah, it really does help the person, I don't know, just be honest and candid, it's a super advantage. But so what do you think it means that Roelof got the slot?
Well, it was, I mean, from my perspective as a total outsider, but having covered, Sequoia for a long time and known folks there, I think the last few years, everybody was watching to see was it going to be when Doug retired, as everybody knew was coming.
Yeah.
Was it going to be Roelof or was it going to be Neil Shen in China, who took the senior steward position? I mean, obviously the last 12 months in both the US and China has, I imagine, changed a lot on that. But this was huge. It's kind of like, this is like the smoke coming out of the Vatican moment, when Roelof was anointed to be senior steward. And they'll all tell you like, oh, Roelof even uses the Animal Farm quote, right? Like, we're all equal here. Some are just more equal than others, blah, blah, blah. Yeah. But this was really, really big.
Big deal. What do you think, Ben? What are your thoughts on this moment in time? Is it a big deal?
Huge.
Huge. Okay.
I think
why?
Well, two reasons. One, the Sequoia Fund, which I want to come back to in a second. But two, Sequoia has been one of the only venture firms ever to do generational transfer incredibly well. Benchmark is another example where the second generation did as good or better than the first generation, and certainly better since venture just keeps getting bigger and bigger. Every subsequent generation does better on a dollars perspective, but on a percentage or an IRR perspective, I think you have to look at, did the second generation of Sequoia do as good as Don or better? I think probably better to look at Moritz and Leone versus the OG GOAT of Don himself. And I think Sequoia, you look at the partnership that they have now, they're just all-stars. I mean, it is an example of generational transfer at a firm done right, which most of the time doesn't happen. Like most of the time, people who started the fund, built the brand, had the initial relationship with LPs, like they hold on for a long time. And I think, the whole venture industry has a lot to learn from building a, hopefully 100-year franchise. I imagine they're looking to be subsequent generations after this that Sequoia has built.
Yes, I think the generational transfer thing, Sequoia has done it well. There have been very, very few firms that have done it. I think why this specifically and Sequoia transfer specifically is so much bigger impact than even Benchmark, a great venture firm on par with Sequoia in the venture industry. They'll be the first to tell you they're a small craft boutique, shoe
by
leather
design,
business
yes.
By design.
They haven't added 20 different parallel projects or funds and then doubled down on the five winners like Andreessen or Sequoia have. Yes.
Sequoia controls so much of the capital globally, and influences so much of the capital globally. Like, think about it. They've got top 3 venture and growth franchise in China, top 3 venture and growth franchise in the US, top 3 venture and growth franchise in India. They've got hedge funds. They've got heritage. They've got the Scouts program. They were part of Y Combinator. Like this, this is like a Goldman Sachs type generational transfer. Exactly. Like this impacts so much around
this is the global
so the
financial
scale
system.
Of it, the footprint has gotten so enormous, and the previous footprint was so enormous, but they let that power dissipate by doing distributions and saying, here's your shares back, LPs, when the LPs were like, okay, now we're going to give them to some investment bank to manage, or we're going to put them in account somewhere. Now Roelof said, hey, we're going to just do this evergreen fund. If we distribute Square to you and now you have $1 billion, or let's just pick a more reasonable, you have $100 million in Square. I'm still on the board. We're still involved with the company. We're not getting off the board. We're now going to stay with the company. We're going to stay with Google. Okay, we're distributing $1 billion to whatever, endowment. Do you want to manage your Google investment, or would you like us to keep it here and then maybe take a little bit of it and put it into the next 5 funds? You don't have to do a capital call. Well, you can do a capital call, and we can just leave it over here, and once a year you take money out.
Yeah,
we'll manage it for you since we're on the board and we were the first investors in the company. Such a
super
good pitch.
high level on the Sequoia fund, to make a software analogy, is that defaults matter. They changed the default from being, a 10-year fund where you do a distribution to LPs and then you go back to them for your next fund and say, hey, can we manage some of your capital again? And they changed the default to say, hey, endowment, that slice of your capital that we manage, what if we just manage that forever? And that is a part of the Sequoia fund, and you are just choosing to allocate a part of the university endowment to us to manage indefinitely. And we have lots of great funds that we can deploy that into. We'll keep you posted. We'll talk with you about the timelines on everything. But it's changing the default to remain involved permanently rather than always get your capital back and re-up next time.
Yeah. It is just fascinating, and it's absolutely selfishly fantastic for me because Roelof is one of my great friends. This is the best possible scenario for me. How does it affect me?
Got to secure the bag.
How does it affect my power base? My power base grows.
What's the secure the bag? I love it. Like I never really heard it till you started using it. Where'd you pick it up? Yeah.
Secure the bag, I think, is a mobster gangster term that then became popularized in the hip hop rap community. So, like many things, Scarface,
hip hop,
Godfather, Goodfellas, Gladiator, a lot of these, seminal works of machismo kind of made their way and were inspiring to hip hop culture in the 90s in New York. And so the idea that even in a brutal world, whether it's the mafia or gladiators.
You mean Y Combinator? Is that? Sorry.
Yeah, the mafia. So there's a perfect segue that you could actually have some honor and that there was some discipline, right? That's the paradoxical nature of our thing, what they would call the mafia. And that's really what the point of The Sopranos is. Our thing, like the last generation was the last beautiful, this thing of ours was kind of perfect. And then it's the decline of what was beautiful about the mafia. I know that's the paradox that they're playing with is like, there used to be honor. You didn't rat on your friends. You did your time. You wore a suit. There were rules. Wives, children were never murdered. We never touched drugs. No sweatpants, no nonsense. And, then all of a sudden, people started wearing hats and there's a great scene. I was literally in my younger years in a restaurant with a group of guys and somebody walked in with a hat and it just freaked everybody out at my table. I used to run with a little bit of a crew that maybe was, and somebody got up from the table and told the person to take the hat off. The person did take the hat off. And that's a scene in The Sopranos where Tony walks up to a guy and says, take the hat off in Artie Bucco's restaurant. That's not that's based on real world events. Like you had to behave a certain way, and
back to Sequoia and Roelof. This is why this is so importantly generational transfer is when these shifts happen. And, Roelof has laid out his blueprint with the Sequoia Fund, but there's going to be a lot more. Like things are going to change now. And we are going to see how it's all going to change.
Here's the great thing. I think also not resting on your laurels is one of the things I take away from this. And the other thing is experimentation and not following. So I don't know if you saw, but Sequoia is launching their own accelerator. Y Combinator
just
says,
in Europe, is that right?
Just in Europe. I don't have any. Just to be clear, I have no inside information. They did not come to me and ask for advice. No,
foolishly.
Foolishly, actually, we're partners, and they meet with all my accelerator companies. It's not like they came to me and was like, "Hey, what do you think of this?" Like they did with Scouts. So I'm just making it clear because people sometimes assume I have inside knowledge. I don't. So making it clear, they did not come to me in this case to float the idea. They just did it. And they're doing $1 million into each company. And they're going to do 15 companies. And they don't say how much they're going to invest. But I think what's unique is they're not trying to do what Y Combinator is doing. They don't want to do 400 companies. They could do that tomorrow. They're saying, we're going to do 15 companies. And I think if they're putting $1 million in, that means they're looking at putting $1 million in for 5 or 10%. So it's basically like they're taking a seed fund and they're adding a 12, whatever it is, an 8-week program, I think. They're adding this 8-week program to a seed investment. So I thought that was a very interesting concept that I might copy. So it's almost like it's more like graduate school. They're kind of like putting a big investment in. And they are not just trying to copy other people. I think the Sequoia Fund, I never heard of anybody doing the Evergreen Fund in venture like that. Is there somebody who did that before them?
There have been evergreen funds, like Sutter Hill's an evergreen fund, but it's a very different design beast and proposition.
Yeah. So what do you think of this?
Well, so at Pioneer Square Labs, we've started 31 companies now in our studio. Different model. We're a glorified co-founder. We've got 22 people, engineers, designers, all that, and we start these companies from
Which
scratch.
means you get some co-founder equity in each company. You get 20% of each company or something just for founding it. What's the ballpark?
More. We're a true co-founder.
So you get half of the equity. Does that fuck up the cap table downstream with other investors where they get jealous and they're like, why should you get 40% of the company? The founders get 40% and we're only getting 20 for putting money in.
As with anything else, there are some investors that have a problem with it. There are lots of investors. I think we have 90 funds that we've co-invested with at this point who are completely fine with it and understand the value.
When the people have a problem with it, what is your response to them? And then what is the profile of the people who have a problem with it? I'm just curious because there's a little jealousy that goes on. I notice. I'll tell my stories after, but tell us how they shade you or guilt you or what's their response to you about this issue?
Well, the studio business is a tremendous amount of shoe leather. I mean, it's running an operating company the same way that running a startup is running an operating company. And I think the people that don't like it don't realize that. And they look at it like, oh, you're just running a fund. And how come you have all this, this like outsized economics for, deploying tiny amounts of capital in your early stage. I just think it's a misunderstanding of what's being done, because no one's looking at the founding team and saying you have too much equity for doing all the pavement pounding you're doing at the beginning. But when you look at like what a founder has versus the second or third employee, it's 10 or 100x less. And so you can't out of one side of your mouth be saying, gosh, it's really about all the equity that's necessary for the next 10 years. And then out of the other side of your mouth saying, but the founder and CEO of the business should have 50x more than the first hire. It's a little bit, yeah.
It is the jealousy of lazy people. This is what I experience.
Everyone has their own perspective, and everybody gets
way too gracious.
But everyone gets it shaped by a worldview that was successful for them. Like the thing that I always have to remember is everyone's got a widget that works well for them, and that shapes their perspective. And like I have my own, and people that don't like this business have their own. And so I think like you're never going to change the mind of someone who is extremely successful doing something a certain way and then tell them that way is not the way anymore. All you can do is say, well, my way is different, and they can both be successful.
Yeah, it's incredibly magnanimous.
Okay, but the point that not to just like, I would literally take this opportunity to talk about PSL.
Way diplomatic.
I want to the reason I brought it up is because I think Sequoia had a very similar insight, which is the deal for early stage investing totally changed from what early stage investing used to be, where you'd put in $1 million or $2 million and own, a meaningful chunk of a company.
10%.
40%. Yeah.
What's back in the day? Back in the day, 40%. And then not too long ago when we started, you put $1 million in at 10 million post, or you put $2 million in at 12 million post, you own 15% of the business, 10% of the business, sometimes 20% for that first seed round.
And so when that changes, and if founders are doing the thing where they open up a node at a very high valuation and just take a bunch of 100K checks or 500K checks, and it becomes unattractive, or the superior returns get arbitraged out of early stage investing, what should you do? You should play a different game. You should find a way to be on the other side of the table. You should move late stage. You should find a way to be fluid based on the way that the landscape has currently changed to produce the best outcome for your investors. And moving earlier than early stage is one way to do that.
Fantastic. We have actually done that. We have something called Founder University now, which was a 2-day free program. We made it a 12-week program. People pay $700 to come for 12 weeks. If they finish the 12 weeks, we give them the $700 back. 94% finished. 85 asked for their money back. I think 10 people were like, keep it. I don't care. It was so awesome. We had 100 people go through the first, and we have 200 in the second. The 100 in the first cohort, they were so good that when I met them, I gave 5 of them $25K each for 2.5% of the business. These are companies that aren't incorporated yet in a lot of cases. I was like, here's $25K to get incorporated for 2.5%. And people are like, you're crazy. What are you doing? Like, that's too early. And I'm like, is it? I mean, if I do 100 of these for 2.5 million, is it if one hits?
You did a great, I can't remember if it was on Twist or on another pod. A few years ago, you talked about startup investing as like the analogy of like your chip stack in poker.
Yeah.
And like, it's all like, where are you in the hand, and how much are you putting into that hand at what point? And it's managing that, right? And like putting in 25K at that stage, like to a large basket of startups, like that's
it's what crazy. We call in the business a feeler bet. There are some people, I've watched sophisticated players. Phil Hellmuth does it sometimes. We're in a hand. The flop comes out. There's an ace and 2 other cards. And he's in second, third person to act out of, let's say, he's second person to act out of 4. And he just there's 800 in the pot and he puts 200. And you're like, okay, there's like 3 people to act after you or 2 people to act after you. 200 is not meaningful. And all of a sudden 3 people fold. And he wins the pot. Or, then that happens in the minority of times. Or, I don't know, 2 people fold. Now he's heads up against somebody. And now he's just got to figure out that one person's hand. And that $200 as a feeler bet, if it pays off 1 out of 4 times, he's break even, right? If you did it $200 and you won 800, if it works 1 out of 4 times, it's a break even bet. So it becomes super interesting as a feeler bet.
You give these people 25K, it's a feeler bet. You see what they do with it, right? Like some of those people are going to take 25K and they're going to do nothing with it. Some of those people are going to take 25K and they're going to go to town with it, and you're going to be like, all right,
and now you have more information and earlier information is like my thesis, right? But it's just, to your point, Ben, it's so hard to do this work. Do you know how hard it is to run Founder University and have 200 people who are building their MVP ask you questions. Like they're literally asking the same 100 questions every week for 12 weeks. How do I raise money? How do I get product market fit? How do I find a technical co-founder? I mean, you have to be willing to suffer through just hardship and the hardship of starting a company, which you do, Ben. Of 10 ideas, how many wind up getting funded of your 10 ideas?
So of the 10 ideas, we start working on about 2 of them.
Okay.
And of one that we work on,
Of 10 that you've worked on?
Of 10 that we work on, one spins out into a company. And every time we spin something out into a company, we have the ability to get it venture funded through, relationships and pre-vetting and all that sort of thing.
So it's like 1 out of 5 ideas make it there. So you have to come up with 5 ideas to get one. And then 1 out of 10 that you build get funded. So that means
1 out of 50 ideas.
1 out of 50 ideas gets funded.
Yeah.
And then out of
But our goal is to
10
not even
ideas,
those
how many
ideas should get
will
thrown
actually
away.
have a return? It'll be 10. So you go 500 ideas to 10 executed to 1 working. I mean, it's a lot.
And the operating business comes in really dialing in what you do at what stages. So the goal would be to get from that 10 ideas to the 2 that we actually work on, do that in an hour and a half meeting so that you just burn through the bad ones as fast as possible. Pick your, most fertile potential ones to work on. And then hopefully you're not writing code and doing heavy design stuff. Hopefully you're able to throw a lot of those out and kill them for customers don't want it or business model reasons or TAM reasons, or the goal is just burn through all the bad ones in the most efficient way possible. And that's the thing when you're really looking at the P&L of running a studio, of figuring out if you're good at it, is can you get through all that crap in a super efficient way?
That is fascinating. And I don't envy you running one of these. BetaWorks, Science, these companies are known for one hit every 5 to 10 years.
But so are venture funds. That's the funniest thing is that's the thing about studios. Oh, well, they did Hims and they did Dollar Shave Club, which is funny that they're both
They didn't really do Dollar Shave Club. They invested.
Totally.
I don't think and I think they've been very
or Bitly or, everyone's got this one cute example of their studio. But Sequoia is one of the few firms where if you back out the winner, they've got another winner. But if you go to one of these super successful firms and you back out their decacorn, it's but that's the whole business that we're in.
Yes, exactly. So it is similar. All right, listen, there's
their news.
There's a huge elephant in the room. Over the last 2 weeks, something happened. We all have to discuss it. It was an act of abhorrent violence and drama. And I need to get your takes on this. Everybody's talking about it on social media. And of course, I'm referring to fast.com shutting down.
I'm just trying to figure out if this was the TF to Elon and Twitter, or is this...
or Will Smith's smack.
Right.
That was the one I was kind of teasing. But all right, this is going to become the Rorschach test of all Rorschachs. Fast is shut down this week, and we just have to go through the timeline here. And this is, I think, going to be... I think the amount of information that's coming out about this train wreck has taken me on a journey of feeling sympathy for a founder I thought was just misguided. And now I'm kind of learning might be a complete charlatan and horrible, but I don't know where I sit in this drama yet. So maybe you guys can help me figure this out. The timeline is pretty simple. Fast raises $2.5 million seed at an $11 million valuation in 2019. 2020, they raised $20 million at a $150 million valuation by Stripe, which apparently is making a mafia bet, according to Ryan Breslow, to create a competitor to Bolt. September, Fast launches its one-click checkout with select merchants, quote unquote, and does the infamous... I'm sorry, September 2020, they do...
Did Fast do Y Combinator? No, I don't think so, right?
I don't think so. If they did, they would have done 7,000 tweets about it and we would know.
Yeah.
Fast launches one-click checkout and does the infamous $5 merch show where tens of thousands of people buy hoodies and have no idea. I think that's probably, there's the Fast hoodie on Nick.
It is.
I think those hoodies cost them $30. So I think they lost $25 on each one.
Lost leader.
It's a lost leader.
Like the Costco hot dog. Like the Costco hot dog.
It's the Costco hot dog or it's the chicken at, who did the roast chicken?
Costco also has a $5 roast chicken.
The $5 roast chicken, Costco sold so many of those, they bought the chicken farm, from what I understand.
Guys, I went to IKEA for the first time in a while.
Oh, yesterday. You did the meatballs? Swedish meatballs?
I did froyo for $1.10.
They have froyo for $1.10?
$1.10. But then I figured, I did some research. I found out the hot dogs, the IKEA hot dogs, they have a policy, or at least they used to have a policy, that they had to have the cheapest hot dog within a 30-mile radius of the store. That was like the stated policy on the pricing on the hot dog. Oh my God, I have a
great idea. I'm going to open a hot dog stand across from IKEA for 50-cent hot dogs. And then we're all going to go in and buy 40-cent hot dogs from them, take the hot dogs and go sell them at Dodger Stadium for $7. So anyway, I'm starting a new fashion label called Jason's Fast, and I'm going to buy up all the Fast hoodies on sale. Okay, and listen, I don't mean to laugh about this story, but it's so tragic and insane that I think there's a little bit of humor in it, and that's how we process things. 2021 Fast raised the Series B at close to 600 million, 84 million, led by Stripe again. Throughout 2021, Fast grows to 450 employees, processes a meager 30 million in transactions to generate $600K in revenue, about $1,300 per employee, which if they were driving for DoorDash would be 100 DoorDashes a year if you made $13 per, or something like that. So if all the employees did one DoorDash every other day, they would have made the same amount of money. No, it's even less. But anyway, at its peak, Fast was burning 10 million a month, generating 50K. In other words, if they had put that 10 million into a bond portfolio and gotten 4% tax-free, would have made 8 times as much money.
Okay, I gotta jump in here.
All right,
there's lots to criticize here, but I hate this thing about the 600K, because what if they just were making no money? Then this wouldn't be the conversation at all. The conversation would be they're building a really complex platform and they haven't launched it yet, so of course there's no revenue.
Okay. Do you think there's any world in which the Fast, I'll take the other side of it, is there any world in which building one-click checkout requires 450 people?
Okay, so this is where you get into like I don't understand how complicated it is to build a checkout solution and like interface with the payment rails and the payment gateways and of course like line up all the deals with the e-commerce providers. It seems hard, but I don't actually understand how engineering hard it is. Is there fraud risk stuff? Is there? I don't know.
But I mean, you do not need 450 people. These guys were playing the momentum game.
As a comp, Friends of Acquired, Modern Treasury, they have what, Ben? Maybe 100 employees, maybe a little more at this point. They are doing money reconciliation, payment operations, like
money
comparable fintech challenge, just as hard, I would imagine.
And 50 of those employees are very new.
Yeah, 50 of those employees are very new, and they're moving close to $3 billion a month at this point.
Yeah.
So no, you don't need 450.
These are very efficient businesses, is another way of saying it. You don't actually need that many people.
So like, sort of, but like what checkout, I think checkout has super thin margins. And so even if your payment volume is super high, I think it's actually hard to build a big revenue business.
Yeah. I mean, your point about turning on revenue then changes everything because you start doing math. So I always tell founders, like, if you're selling the promise of this, do not bring up the performance. Don't do math.
Right.
Because people, if you go to a bunch of smart people and you're like, yeah, we make $10 per customer. Like, how many customers you have? 1,000. Okay. So you make $10,000. It's like, well, how often do they spend $10 with you? Every day or every year? It's like, we sell them this meditation app once a year for $10. That was literally Com's business. And then it became $10 a month or $6 a month. And all of a sudden the whole economics changed and how you viewed the business changed. And rightfully so. But I guess to me, what I find fascinating about this, and I'm interested in your position on it, is the founder. And just to wrap up, things started going wrong in late Q4 of 2021. They tried to raise $100 million at $1 billion valuation, right as the markets were repricing stocks. Then they tried to do a down round at a $450 million valuation, and told potential investors it planned on doing a layoff to cut its burn. And then in March, they told investors they were looking to be acquired. And then in April, they shut down. So literally, this feels like, to me, malfeasance on the part of the board, the investors, and the founders and the management team to run a company at this level of speed with no brakes, no guardrails, no alignment on the car.
Are you suggesting they ran it fast?
They ran it very fast, too fast, in fact. And this is just malfeasance. And I think there's something wrong with the founder here, because somebody did a tweet storm about his history, and he's got a long history.
That. I think did you retweet it, or you engaged with it?
I retweeted it, and I was like, none of this could have come up in diligence. And I don't know if any of it's true, but we're showing right now the graph of like the employee count, which, employee count does correlate. A lot of investors will look at the employee count chart on LinkedIn and use that as a proxy for how the business is going, which is a fine way to find high growth companies. But then you have to look under the hood and say, is that growth line in any way related to the reality of the economics of the business? And in this case, it was not. Adding more people to this business did not help the core business. I think that's the cardinal sin here. But pull up the tweet storm if you can find it. I retweeted and said something to the effect of like, I'm sure none of this came up in diligence. Make that like 3 times bigger so people can read it. And then just throw it to me in the tweet.
That's your new tagline. I'm sure none of this came up in diligence.
What happened here, I think, is maybe Stripe was so wanted revenge on Bolt so badly. This is just a theory that they saw this kid as a proxy for this kid, Dom Holland, who I had on the program, who didn't seem super sharp to me. And, listen, I want to make it personal, but I didn't even want to have him on the program, but they kept begging to be on the program over and over again. And I was like, this person's too much marketing. What do you say about Acquired
when we're not on the show?
Anyway, listen, I would love to have Dom back in the program, but they were super aggressive about the marketing. And it was always this like promotion and marketing. And they named the people at the firm, like when people get called Googlers and like they self-assign themselves, we're Googlers, we're Amazonian, whatever. Like they were kind of trying to create that mythology. It was almost like an Elizabeth Holmes kind of derangement of like, we're going to do all the accoutrement and theatrical stuff for a startup as opposed to what needed to be done, which is product market fit. But anyway, he's got a background, according to this, where his background here is that he was involved in a towing business and other businesses where he was incredibly smarmy and confrontational and I guess accused of being a charlatan in previous businesses. And we'll put in the show notes a link to this. But what is the takeaway here in terms of late stage venture capital?
Well, I don't know.
I say late stage, not as in the stage of investing, but as
I see, like
the
late stage
capitalism. Of late stage capitalism, and then in parentheses, venture specifically.
All right.
What happened here?
I think there's plenty to criticize, and I will. I'm not going to be like
let's start with the criticism.
Diplomatic, but like, okay, here was a thing that was going super well. They built like an insane team in the first like year. So like they knew how to meme their way into bringing very talented people on. So
so
going back to my earlier comment of like when something works well for someone, they kind of keep doing that thing because it's the thing that they know works. So you like you're trying to build an amazing, and I actually do, from all accounts of people I know who are hiring fast employees right now, they're like, the talent density is crazy high. So like in some ways that can sort of explain the psychology around why do we need to build an enormous team so fast, because it was the thing that was working. Now, when we look at the Stripe angle, Stripe's a B2B company. They have no consumer relationship. And consumer relationships at scale are crazy valuable. But of course, like a lot of the consumer touching businesses are really hard to build. And also, if you look at something like a checkout solution, super thin margins. So their revenues were going to grow really slow. I think Stripe kind of looked at this and was like, opportunity for us to have a consumer relationship. Maybe this is like our option bet. And if you were going to go about making an option bet on something that you think could be really important in the future, but would be really hard to get sort of mass penetration on, you kind of think, okay, well, then the founder or this business needs to have some unfair advantage where they actually will be able to will something into reality from a cold start. Like they need to get installed on all these e-commerce platforms. All these merchants need to adopt them. Like something crazy has to happen in order to allow them to thread that needle. One way, I don't know if it didn't work, but one way you could do that is effectively memeing yourself into existence, where you build the 5-year aura of a successful company around your brand persona. you attract all the best people. And at some point, if it's like if you did actually have a strong brand and you do actually have all the best people and you do actually have Stripe backing you 3 rounds in a row, you could call it bad money after bad, but backing you continuously, a high value, at some point, like you could actually get the customers to show up and believe that this is great. And if it actually was a great product, which I don't know, that's a plausible strategy. Didn't work at all, went up in a ball of flames, but like you can see the strategy.
David, one of the great things about entrepreneurs is they get good at something, they do press their advantage. And all executives, Bob Iger's a great deal maker. He goes on the deal run of all deal runs. Somebody's a great operations person, like Frank Slutman at Snowflake. He just fires people who are average or good performers and replaces them with people who are good or great. And and everything's a war to him, right? So it's an operational machine. He's not out there banging the drum and doing marketing. He's just destroying people who work for him who are not good or who are good. And he's like, you're not great. You're only good. 8.5 out of 10. You're fired. Fast as and slow as we go. So what do you think of, Ben's defense of a founder?
It was more of a hypothetical defense.
Okay, hypothetical defense. You want to take the other side, Ben. You got to be a big boy. And then David is I took the other side. Now David's going to referee. Go ahead, David.
Oh boy. Okay. Yeah. I mean, I
deciding vote, David. Who's right?
This particular
me or
thing,
Ben?
I think Jason is right, but I think Ben, you would probably admit that too. Like this was the running of this company was a travesty. Probably, is it Theranos scale? Probably not, but like it's somewhere between a travesty and a Theranos. But the reality is,
on a scale of 1 to Theranos, where do you rate this in fraud or malfeasance or incompetence? Theranos being a 10.
Lives were at stake, so there's no lives
being
at
a
stake
7.
Here. Yeah.
Madoff being an 11.
I don't know. This is pure speculation because I know none of the details, but I'm guessing a 4. I don't know, something like that. But the reality is, like, one modern treasury funds 10 fasts from a venture capital standpoint. So like, this is the thing. These are like big flashy stories. It's like watching a train wreck. Everybody gets excited, but they happen because like the economic incentive for capital is like, sure, let's fund a bunch of these and one of them's going to work.
Here's the things I don't like about this. Number 1, governance. Who's on the board of Fast that allowed this person who had a sordid background to run amok and burn money at this rate? Who was in the meeting when they presented a 2-year plan that made no sense and didn't put their foot down and say, maybe we don't need 450 people? Where was the governance? So that's my first question.
Well, and that was part of the problem. Like, you got Stripe leading these rounds. Stripe's a great company. I'm sure all the people there are great.
Were they
I'm sure
on the
investors
board?
Are great, but they're an operating company. They're not, board members.
And this is where strategics are. So number 2, when we talk about strategics as investors and we're like, you want to do a strategic round? Fox in the hen house distorts what the goals are.
Term sheet, probably. Like, strategics always have some non-pure financial incentive.
And that's exactly right. So you put a strategic in here. Listen, Stripe's among strategics, I understand, like a founder wanting to take their money. But this is what happens when you lay down with a strategic. They have you're gonna wake up and you might not be in the position you want to be in. Like, this is the absolute pinnacle of why strategics are kept out of high growth early stage companies, is because they're going to have a distorting effect. 3, the scale of investment is completely unnecessary, and we're breaking the milestone based system that makes our industry what it is. So governance, strategics, and milestone, all 3 of these things were thrown out the window. And then finally, diligence, which I don't know how much of Dom's past is being exaggerated. There's 2 sides to every story, yada, yada. Some people are polarizing. Some people knock a lot of shit over while they build the future. I get it. But that's what I want to know about. That's the piece that's missing for me, is governance, strategic, diligence. And what was the 4th one I came up with? Oh, milestones. Yes. Yeah. So let's talk about the milestone-based system of Silicon Valley. Somebody comes up with an idea. They go to an accelerator. The accelerator accepts them. Okay, you hit a milestone. come out of the accelerator, you beat the other people coming out of the miles, or you meet a bunch of investors, you pass market with a bunch of seed investors and dentists and seed funds and angels. Yeah, you get product market fit, you start scaling, you get a venture firm, you get to true scale and predictability, you build a management team, you get to your series B, C, D, E, you go public. Is there a major risk here, Ben, that people have forgotten the milestone-based system that got us where we are today?
Yes. And that is not just like Fast is the most fiery example to talk about that. But over the last 5 years, everyone shifted one click down the round system in what they were looking for. We heard all the time, Series A is the new B, C is the new A.
One, probably 2 or 3 clicks.
Right. The invention
I was thinking the same thing, David. Maybe we moved 2 clicks. And in this case, 4.
Pre-seed was not an asset class that previously existed. In fact, even 10 years ago, seed wasn't really an asset class that existed. That was angels. So we invented 2 brand new clicks in the whole thing. And in doing that, I think we got everyone so comfortable with the idea of moving their underwriting criteria 2, 3, 4 years earlier in the life of a business for that amount of capital that there is sort of the risk of the whole thing of people being so insensitive on price versus milestones that, yes, I think we are in a very high risk, non-resilient system right now. Like everything kind of Fast is a great example of this. The playbook that they were executing, assuming there was a sane strategy and they had a good discussion about it, that was just not a resilient strategy. If everything went right, it maybe could have worked, but they did need every single thing to go right everywhere along the way, and there was no slack in the whole thing. A lot of the people who choose to raise rounds like this that aren't hitting the traditional milestones are basically just reducing their resilience and requiring that everything go right in order to create some positive outcome. And as the whole venture system shifts to that, yes, all these investments take on much more risk.
Well, and Jason, what you've been saying, it goes hand in hand with governance, right? Like milestones and governance go hand in hand. And I think, actually, if you read a lot of the stuff that Roelof wrote, I think probably even in his memo around the Sequoia Fund, that's what he's all about. And I think what they're trying to do with the Sequoia Fund is like, if you set up incentives such that when you invest in a company, you care about the long-term, economic outcome of the company, then you care about milestones and actually building stuff and performance. Whereas so much of the venture industry, and, I'll raise my hand, like myself included in the type of stuff that I do, is instead based on markups, based on making the fund look good, based on TVPI, based on selling secondaries, based on getting liquidity. And that's how you end up with stuff like this.
Yeah, it's really crazy that people have forgotten what got us here. The number one reason we've turned things down of late, or in the past year, was the valuation just didn't add up for us. And we were like, if you're raising at a $50 million valuation and you have no revenue and you barely have product market fit, well, we could just focus on accelerator companies or do $500K into 10 seeds that have their first 5 customers, and we don't have to worry about you going from 0 to 5 customers. We've already got 10 opportunities. So it was like, I love the founder. I love the business. I love the product mock-up, but I have other options. And if you have other options, then why not focus on the other options, I think is the case. And so discipline is what's needed. Governance is what's needed. Governance is actually cool. This company with proper governance would have had somebody pump the brakes. And I'm not throwing shade at the board members, from Stripe or Index, or Brian Sugar's a friend of mine, is an angel investor. Maybe he was on the board. And who knows, maybe Dom negotiates some sort of board control. But, governance is important when, and having a co-pilot. If you think of governance as like a really good co-pilot, when you're in the soup, when you lose an engine, like having a co-pilot reading that list for you. Okay, now step 1, reset the engine. Step 2, check the oil gauge. Step 3, flip the, circuit breaker. Step 4, do this. Step 5, check your altitude. Like one person's flying and one person's going down the checklist. Like this is why modern day aviation is so radically different. Read the book, The Checklist Manifesto, and you'll learn about this. This is why people survive surgery and plane problems, aviation challenges and disasters get avoided, is because of good governance, good checks and balances. So I think that to me is the big lesson. Give me a company as we wrap here that you're super excited about. It could be any company you've invested in, but at this moment in time, this week, this month, something happened that made you excited about that company. Something that made you excited about a company in your portfolio.
While Ben's thinking, what's top of mind for me right now is NVIDIA. We're in the middle of our NVIDIA series here. And, I don't have a particular view on the stock. The valuation is incredibly high right now. But, God, what they've built, it's such a story that
I was thinking a company you invested in, but okay, we'll go with that one.
Yeah. Jason, what do you talk your book? And David's
talk
like,
your book.
I'm like, talk your book. David's like, I don't have any investment here, but sure. What do you got? What do you got, Ben? Let me go to Ben, and then I'll come back to you, David. Ben, what do you got? You got something queued up. Could be one of your studio companies that's getting traction.
Well, it's funny. This is like a PSL acquired sandwich. So we just had the founders of Trova Trip on our LP show. And I think that episode's going to come out maybe tomorrow. But they've built, it's a travel company that lets groups of people go on trips with creators that they already follow.
Oh,
so the
I know
creator
this.
Stands up a trip on Trova Trip. It's run by a third-party operator from Trova Trip's platform.
Yes, we looked at this, actually. I was very intrigued by Trova.
Oh, yeah?
Yeah. Did you invest in it? Or
Yep.
Is this a studio?
So full disclosure, I'm actually on the board representing PSL Ventures. And
it was a female founder? I believe it was a female founder?
Yep, Lauren and Nick.
Lauren and Nick. I remember meeting Lauren. Yeah, it's a really cool company. So you, as an influencer, say, I'm going to do this trip. You get to go for free. And you might make a 10% or 20% of whatever dollars come in.
Yep.
And then your fans, so if you did an acquired FM, goes to, I don't know.
Somewhere more exciting than Sand Hill Road, hopefully.
Well, I mean, it could be something cool like, we went to the Rosewood on a Thursday night. What an adventure.
That is exciting. That is truly exciting.
But yeah, we could take everyone on like a backpacking trip in Patagonia.
Yes, and it could be something epic. They pay $5,000 once in a lifetime, and they get to go with two people who they would love to be affiliated with. You're selling a little bit of access. We looked at this back in 2019, and I fell in love with it. But I don't know why we didn't get there. I have to look at my notes, but maybe I got to make up for this mistake. Mine is going to be anyplace.com. This is something we incubated, and they were originally started by letting people do short-term rentals in 2- and 3-star hotels, which had so much availability. And living in a hotel was great. And for nomadic people, it was great because but hotels didn't want to take the risk of people wind up domiciling there, and they didn't know how to run. So think of it like as an Airbnb reaction. Hey, the hotels, that are being impacted are not the 5-star hotels. It's the 2- or 3-star hotels that are $200, $300 a night that Airbnb is beating. But then living in a hotel is pretty dope because the hotel just says, okay, we'll change your sheets once a week, as opposed to every day.
I have wanted something like this before. This is great.
Now, what they did was they did an experiment where they set up a podcasting studio, a widescreen monitor, a standing desk, and they made their own kind of curated spaces at anyplace.com, which are designed around people who need to be on a green screen all day or whatever. And so here you go. You can do short-term rentals if you're a podcaster, if you are in-house sales, if you need to do whatever, or you live a nomadic lifestyle. So if you wanted to spend a month in Miami or Los Angeles, you could go to your boss and say, hey, can I rent this for a month and, be in your backyard? So if somebody working for me said, hey, I want to spend time with you every day and we're going to do a retreat, we'll go for 2 weeks. Everybody gets a room with an office in it, basically, a home office in it. So it's a pretty cool idea. I encourage everybody to go try anyplace.com. Free ad for them. David, do you want to, all your portfolio companies are like, okay, Ben understood the assignment. Jason understood the assignment. David did not understand the assignment.
But
David,
I did
here's
because
your
I was talking about acquired. So
that's true.
Somebody wants you to.
If only more people were curious about listening to podcast episodes about NVIDIA, where would they turn?
Where would they turn?
There's
on,
3
Jason,
podcasts.
I'm just playing the game at a different level here.
There's the NVIDIA.
I could get 30 seconds talking about a portfolio company here, or I could get 3 hours talking to people on my own podcast.
Give us a portfolio company. Let's go. Your whole portfolio is on edge this year. There is a portfolio company. It's called NVIDIA. They have this really interesting chip. It's going to be big, everybody.
It's going to be big.
We encourage everybody to look for an NVIDIA chip in their next laptop.
It's a
I love it. All right, I want to give a quick shout out to my kindergarten partner and portfolio company, Kettle. You've had Nat on the show. They are really rocking and rolling. They're building a reinsurance company. They're building a new reinsurance company. It's amazing for climate risk. You've talked a lot about it on the show. Yep. We've talked about it, but like it's working. They're building a reinsurance company. So great.
Got it. There it is. Ourcrowd.com, I think, is the one to take a look at. So for all the venture capitalists trolling for investments on this podcast, there's 3 for you to look at. We're talking our own book, everybody's favorite part of the program. Thanks again, boys. You always do a great job, Ben and David. Go check out acquired.fm, search for it in your podcast player, and look forward to guesting over at Acquired at some point soon. We got to find a third person and let's do like a little mini super team over there. Ooh. Oh, you know what? I'll bring Molly over. That's what we're going to do. I'll bring Molly over. Great. And we'll come over to your house and you guys can cook us dinner.
All out.
Love it.
All out. All out.
Well, thank you for having us.
It's
Blast as always.
It's super controversial now. Like there's a group of people, like the overwhelming majority of people love that podcast, and it hit like 31. So yeah, thank you. And people are copying it now. Like there's some venture capitalists did one, and they basically said, we're just copying it. We're just going to take there's like 3 of them now, where they're just like, we're just literally taking the exact format. We're going to make a joke. We're going to have a J-Cal. We're going to have a Sax. We're going to have a Chamath. We're going to have a nerd science.
There's only one J-Cal. And
well, yeah,
Sax
of course. Yeah. But I mean, listen, it's fine. People want to try to, but it's flattery. But, there's a group of people who maybe disagree with 1 or 2 people on the pod and are like upset at me, or then they back channel to Molly. Molly, can you talk to J-Cal about what Sax said? Can you And I'm just like,
even J-Cal can't talk to Sax about what he said.
Well, whatever. I'm just giving one example. It could be Freeberg and another, or Chamath and another, but it's like,
who hates Freeberg? Freeberg's the most wholesome.
When he said, anyway, I'm not throwing any of my besties under the bus, but what I would like to encourage people to do is you can be friends with people that do not agree, have your exact worldview. This was the strength of America, you absolute morons. Be able to sit at a table with somebody who voted differently than you, or likes films that are different than the films you like, or they love golf and you love poker. Vive la différence. What is wrong with you people that you can't even sit and talk about things that are important with people you disagree with? It's a road to disaster if you cannot maintain civil discourse or even uncivil discourse with a group of people who are different than you.
It's so insidious. It's like it's everywhere in society, but it's in Silicon Valley too. And that's just so depressing. It's ridiculous because that's not what's like Silicon Valley is about. Differences.
They literally, like, there was like this Overton window, and like from one side, the Republicans were like, here's a piece of plywood. And they put a piece of plywood. And then the left people were like on the inside, and they're like, oh, you put plywood on the Overton window? They just put their plywood on the inside. So now we got this like Overton window that used to be super wide open. We could talk about anything. Oh yeah. Should we have affirmative action? Should we not? Like, I don't know where I stand on affirmative action at a college. Should it just be merit-based? Like, this is super complex. It's going to the Supreme Court. None of us know the answer to how admission should work equally. Does anybody know the answer to that question? If we did, we wouldn't be sitting here struggling with it. So be able to discuss things with people who have a different opinion and then have the humility to be like, I don't know how to deal with Putin. He's a sociopath.
Yeah.
He's a dictator. Like, does any of us know how to deal with Putin? What's that?
Like, if I were like if I was very good at geopolitical strategy, like I would be doing that, but that's not my job, and I don't know that is not my strength. So I'm probably not going to spout off on a
perfect quick example about this. We were just visiting. We have really good friends from business school who live in Dallas, and one of them is a oil and gas private equity investor. And the last few years have just been brutal for him. So many of his LPs have just been, their university endowments, and they're like, well, our students, our constituency banned us from investing in this anymore. And the whole time and now like with Russian Putin, he's like, yeah, I mean, it's a lot better. Our world runs on oil and gas still. Like, yeah, it'd be great if it was sustainable, but wouldn't you rather get the oil and gas from America than Putin? Like, it's so short-sighted what people have been doing.
Yeah. All right. Listen, everybody follow Ben, everybody follow David. Great conversations. Let's have more of them on the more difficult subjects. We'll see you over at the Acquired FM feed with Molly. Set it up. Nick, let's go. Let's keep these conversations going. All right, boys. I'll talk to you soon. Take care, David. Take care, Ben. All right, everybody, Lon is here for This Week in Streaming. Molly is on vacation. We got to start with the Dropout.
Let's talk the Dropout. Yeah, it's over.
Now, this is the 8th episode. It's over.
It's done. That was it.
It's done.
We saw the finale.
My perception was they took their time up to episode 7, and then episode 8 was just like so much happened in such a short, compressed period of time.
A whirlwind, yeah.
It was a whirlwind. On a storytelling basis, was the whirlwind something that you liked about the 8th episode, or do you feel like they should have opened it up to 8, 9, 10? Or do you feel, third option, like they compressed it, and then I think they're doing season 2, they could go back and expand. Are they going to do season 2? Did you hear? I haven't heard about that. I think she said, Amanda Seyfried said she wanted to do season 2. There's no way they're not doing a season 2 because Balwani's. We have to hear the end of the Balwani story.
I mean, there's more story to tell. They could keep going for sure. I like the finale. I mean, it does feel like once this is where it all gets away from her. And by the beginning of this episode, the forces have sort of aligned against her, and it's one thing after the other. And they sort of have that moment where it seems like they get away. The story comes out, the board agrees to stick with her, and there's this kind of eye of the storm moment where it's like, oh, maybe we got out. And then immediately after that, Medicare comes in and shuts down the lab, and it's over for real. And I like that. I felt like it captured how it must have felt for her, where one moment she's still interviews and top of the world and billionaire and genius Elizabeth Holmes. And then literally the next minute, her own lawyer is like, I'm leaving. You can't afford to pay me anymore. We were never
such
friends.
A good observation about the Dropout and how they did the storytelling, which is they may have made the editorial decision that frauds take a long time to be discovered. Mm-hmm. And it's a long, slow process, investigative journalism. And the fraud builds and you're covering up mistakes with more fraud. But then when there is a tipping point, the plane falls from the sky.
Right.
And this was the plane is soaring to all new heights. And everybody's like, there's something wrong with this plane. There's something rattling. It seems like it's off course or whatever. And then boom, the engine blows and it is in a descent and a free fall that it is not going to get after. And the John Carreyrou story is that slow burn. I felt like I could watch just the John Carreyrou story for 8 episodes. It left me wanting more.
Right. And I think that they did narratively, I don't know how realistic this is, but narratively, they had this great moment of it's that one interview. It's that TV interview she does where she can't really answer anything and she doesn't seem sorry. And she just keeps repeating that she's devastated because that was the line that they gave her, like, oh, really hit this in a humane way that you're devastated. And that's the moment. I think everybody sees that. And that's the moment where it sinks in for George Schultz and for David Boise or whoever.
When he pieces out, he just leaves.
Yeah.
He's like,
oh, it's over. She can't convince anybody. This is it. It's all going to collapse around her and we're gone.
My favorite scene, and then I'll get yours, was them coaching her on how to apologize. Mm-hmm. And there's sort of like a pairing of her Asperger's qualities. Again, I don't want to diagnose. I don't know if she's been formally diagnosed, but they were, all but saying it, that this person has the inability to communicate like a normal human. And she says, I'm different. Mm-hmm. There were 2 or 3 scenes where that came to play. The one is she can't apologize. And she keeps saying, I was devastated. It was devastating.
Right.
But she can't say, I'm sorry. And everybody around her is just like, is it so difficult for you to just say you're sorry? Then there's another scene with Balwani where she reveals, oh yeah, you dated me when I was very young, didn't you?
Right.
And he's like, well, I have all these emails. And then she's like, well, I was barely 18, kind of insinuating, this Svengali.
How badly this could play for him. All of these scenes of if you look at it from this perspective,
yes,
I can make you look very bad and leave you sort of holding the bag for a lot of this. Yeah.
Yes, the Rashomon moment. And then there's the final moment where she's just like, I got a dog and a boyfriend, and she's under the cover, and I think they're kind of insinuating maybe she's on Molly and she's kind of living her best childhood again, which she gave up because she's going to Burning Man. So those are my 3 scenes, but you riff on those of what you loved about the last episode.
I was going to pick the bit with her and Michaela Watkins early who's the lawyer. She was the head lawyer for Theranos. Earlier in the episode, they have this great moment with them where she goes, you've really become a good friend. And you can see in Michaela Watkins' face.
I don't have friends.
Right. In Michaela Watkins' face, you can see she doesn't think of this person as friend. They've been spending all this time together because she's in devastating legal trouble, not because they're hitting it off and getting along. And interesting that this episode of WeWork, which you may not get time to today, also plays around with this idea of like, these people don't really understand what friendship is. It's always... Every relationship is transactional.
Yes.
And there is no like real friendship there. It's just what can this person do for me or get me or reflect for me or give me. So there's that early scene. And then later when Michaela Watkins doesn't even work there anymore and she's just saying Rupert Murdoch sold all of his shares for $1. You should get ready to go to bankruptcy court.
She's like, can you do that for me? And she's like, I don't work for you anymore. You deranged sociopath.
This is my friend. And like, no, this is somebody you screwed over. This is an employee who was counting on you, who's now out on their ass. And like, I thought that the I don't know if that really happened, but the tension of that scene, like the way that they personified everything that was going on in 2 people, I thought was really good, where she's literally chasing her out of the Theranos office and into her
and
Uber.
It shows, I love your point about the inability to form actual relationships. And also sociopaths and narcissists do not care about the fallout around them. And that is the tension of what's happening in the Dropout is she actually does not care. She got a dog, she got a boyfriend, she's on to the next thing. And and the lawyer, and this is a lawyer who's defending a sociopath. So she's of moral questionable authority already.
Yeah.
And even the lawyer who's defending a sociopath is like, you hurt people. Like, these are real people. Like, what the is wrong with you? This is an attorney who was trying to, screw over the widow and the person who committed suicide over this. That's how cutthroat she is. And even she has been pushed to the breaking point.
And was waiting in George Schultz's bathroom to ambush his grandson. I mean, yes, he was cutthroat. Yeah.
This is like Darth Vader being like, dude, that's dark. Like, why would you do that?
I mean, it's interesting too, where it plays with the idea of what it means by the dropout. Because the whole series you're thinking of, well, she dropped out of Stanford to start this company. Yes. But it's really the ability to just move on, I've been doing this. This was the thing. Oh, it's not working. We tried. To the next thing.
And the delusional speech she gives on the way out, which is like, they tried to stop us. They're just not ready for true innovation. And it's like, or you're a sociopath who surrounded yourselves with sociopaths and you could have done this completely differently. Absolute great storytelling.
Yeah.
Liz Merriweather is the show's creator. Mm-hmm. And she... Amanda Seyfried is lobbying to do number 2, but the quote from Liz, I would love to work with her and all the people who worked on the show again, but the story has gone as far as I want to go with it, which means, okay, let's let another creator do it. Hand it off.
I mean, we've heard a lot of stuff like that often before. And then so like White Lotus, when it was like, this is a one-off thing. We're not going to, and now they're coming back for season 2. They keep saying Mayor of Easttown. Who knows? Maybe they'll do another one. I wouldn't say that's the
negotiation, right? It's a negotiation.
I wouldn't say definitely not. I would say, let's see,
show me the money.
2 more weeks. And then let's see what happens with the case. I mean, does Sunny Balwani end up going to jail? Are there more developments?
What do you think, just based on what we saw on the show? Let's assume the show is pretty close to reality.
Right.
Based on the show, what is the proper sentence? We are not judges. We know nothing about the legal system.
I don't know.
But we did watch this series on a moral or ethical basis. Who is more culpable, Balwani or Holmes?
I mean, it seems pretty similar to me, right? Like Balwani, I know I was reading about his big argument. I think they mentioned this in the show, is that he didn't draw a salary. Like, well,
there was no profit.
I wasn't profiting. So how could it be me doing a fraud? And I think that honestly, like as, shifty and semantic an argument as that is, I think there is something there. It wasn't his company. He was on a very core level, helping this other person out.
Yes.
And it was her thing. And she was the one taking all of the accolades. And I'm the CEO and I'm the founder and I'm the billionaire genius and the Steve Jobs. So on that level, she's setting herself up as the figurehead. But they're definitely both I don't think either of them should get away scot-free.
But you if you would tilt a little bit more blame on the CEO. Makes sense.
It's just kind of a buck stops here sort of thing. Like she was in the position to, when he's like, hey, maybe we should crack open these Siemens machines and look inside there.
Yeah, she could have said absolutely not.
We wouldn't know. Why would we do that? We're a medical device company. We need to make our own technology. There was that moment when she could have done that and she did not.
Yeah. Yes, there were ample moments for her to stop the fraud. And in fact, the show shows her contemplating stopping the fraud.
Right. And I think this goes even one beyond just fraud. I mean, fraud is bad. Don't do fraud. It's a criminal offense for a reason. But I think this goes even beyond financial fraud because it's medical records. I mean, it's like, as they said in the end, people giving incorrect cancer diagnoses, AIDS diagnoses, misdiagnosing a miscarriage. I mean, this is very serious. This is people's health.
It's very serious, and what a great show. They have to do a second season. It's the best thing I've seen on Hulu since Dope Sick. I don't know.
Dope Sick was good. I like Dope Sick as well. A lot of good stuff on Hulu these days. Atlanta, season 3 of Atlanta on Hulu right now.
I didn't watch season 2, which I heard was an artistic tour de force. I love season 1. It's just very hard for me to keep up with this, and we will be back with Lon next week to go over with Molly. We Crashed, which is on episode 5, and we'll have episodes 5 and 6 if you want to catch up. And then we're going to start Severance. Ben Stiller. So we're going to keep doing this every Thursday, and we'll start Severance. I'm just starting episode 2. So if you want to catch up with us, I think maybe we'll do 3 episodes of Severance.
Severance is ending tomorrow. The finale.
Right. So maybe we'll do 2 or 3 episodes.
So I think as many as you can, as many as
8 episodes, ready. 7 episodes?
There's 8 total in the first season.
All right, so maybe we break it into 3 weeks. So we'll do like 3 episodes, 2 episodes. That would be a good way to do it. Okay, we'll see you all next time. Bye-bye. Thanks, Lon.
Hey everyone, producer Nick here. I want to tell you about the SaaS Syndicate. If you're a founder of a SaaS company with a product in market, our investment team wants to talk to you. Head over to thesyndicate.com/SaaS, SaaS, to apply to raise from the SaaS Syndicate. And you can join Jason's syndicate of over 9,000 accredited investors at thesyndicate.com.
Producer Justin here. Know a cool startup? Check out openscouting.com, where anyone can refer a startup to our investment team here at launch, even if you don't know the founder. If you're the first to flag a company for us and we decide to invest, you'll get $5,000 in cash or 10% of our carry.
Hey everybody, producer Rachel here. Are you an early stage startup that has product in market, some traction, and are looking to raise at least $500,000? Apply today to Remote Demo Day for your chance to pitch to over 9,000 investors in Jason's syndicate. Submit your application at remotedemoday.com. Our next event is on April 27th.
And if you want to learn how to invest in startups from the world's greatest angel investor, and no, we're not talking about Chris Sacca, then head to angel.university to apply. The 4-hour workshop costs $300 and all proceeds are donated to charity. To date, we've donated over $175,000 to various charities, and you can see the full list at angel.university/charity.